Welcome back to the Culture of Currency. Grab your favorite coffee as I have. Settle in and let's pull back the curtain on what an absolute whirlwind of a week for the American economy and a couple of international things, of course. If you spent any time watching the ticker this week, you'll know the financial landscape felt a bit like a roller coaster operating in high winds. From energy volatility and international conflict to the corridor of the Federal Reserve, the markets have been processing a massive amount of data, all while trying to answer one big question: where are we heading next? Let's start with the big engine driving everyday cost, which really drives every nation on Earth, and that's energy. According to recent updates from the U.S. Energy Information Administration, the EIA, crude oil prices experienced notable shifts this week as geopolitical frictions across the key supply corridors, Strait of Hormuz, for example, raised fresh concerns about global shipping routes and distribution channels. Whenever regional conflicts threaten energy heartlands, energy traders price in risk premiums. It's basically an instant thing. According to market analysis published by Reuters, high energy benchmarks continue to trickle down into transportation costs, keeping pressure on domestic fuel prices and creating a secondary ripple effect across manufacturing and grocery supply chains. That energy turbulence feeds directly into the economic numbers our policymakers watch like a hawk. And that brings me to the centerpiece of this week, the Federal Reserve's rate decision. According to official commentary from Federal Open Market Committee, the FOMC, the Fed elected to hold interest rates with a restricted target range as they continue to weigh job growth metrics against stubborn inflation signals. According to report data from the Bureau of Labor Statistics, consumer prices have shown resilience in core sectors, meaning central bankers are walking an incredibly delicate tightrope. Lower interest rates too fast and inflation risks reigniting. Keep them high for too long and corporate borrowing costs puts a squeeze on expansion and hiring. Speaking of expansion, I have a question for you that I hope you can answer in the comments. Late this week, we saw what seemed to be a coordinated mass migration event happening where thousands of migrants rushed the border of Spain and overtook it, causing a lot of dominoes to fall, such as other nations temporarily blocking normal travel rules with Spain. I want to hear your thoughts on this in the comments, especially if you are one of my fantastic European viewers. The reason I ask is that we all witnessed Greece years ago having a migrant crisis with Syria that broke them economically, leading to the EU and mostly Germany, really, in many ways needing to rescue Greece. Is that something that could be on the table here on the horizon for Spain if they cannot secure their border? History is lighting up my warning beacons on this, and speaking of history, economic history teaches us that while we may not always know the exact path we tread, innovation, adaptability, and resilience consistently write the final chapter. Now, if you ask 3 different Wall Street analysts where we go from here, you'll likely get 4 different opinions. We are undeniably walking an uncharted path where traditional economic playbooks don't always align with modern global trade dynamics. However, according to the forward-looking consensus reports from Goldman Sachs Global Investment and Research and the Conference Board, there's strong silver lining emerging amidst the uncertainty. Many chief economists point out that despite elevated interest rates and geopolitical headwinds, consumer spending remains remarkably steady. Corporate productivity across technological sectors continues to surge, and supply chain adaptations have made domestic markets far more resilient than they were just a few years ago. Indicators show that while the short-term trail might have a few twists and turns, the underlying structural engine of the economy remains adaptable, resilient, and primed for long-term growth. Now let's shift our focus to our physical assets, because what has happened in the precious metals market this week has been a fairly new normal. If you haven't been keeping an eye on the charts, you've seen gold holding firm right above $4,000 an ounce, while silver continues to trade right at the doorstep of $60 an ounce. What's driving these levels? Well, according to market commentary from World Gold Council, a massive driver behind gold maintaining its position above $4,000 continues to be steady multi-quarter buying from global central banks. Sovereign nations around the globe are actively diversifying their currency reserves into physical assets like gold as a strategic hedge against the currency fluctuations and sovereign debt burdens. Add in strong retail demand and safe haven buying amidst global geopolitical tensions, and gold has established a firm technical floor at levels that would have sounded impossible a decade ago. Meanwhile, over in our silver camp here, the story is fairly compelling as well, driven by a unique double engine of industrial demand and monetary backing. According to annual data published by the Silver Institute, the global silver market is navigating a multi-year physical supply deficit. Unlike gold, which sits largely in vaults, silver is consumed daily in massive quantities across high-growth industrial sectors. Solar panel manufacturing with photovoltaic capabilities continue to expand globally, consuming hundreds of millions of silver ounces each year. Electronics and EV tech, from electric vehicle power grids to an advanced computing chip, silver's unmatched conductivity makes it indispensable. According to commodity desks at JP Morgan, when you take a chronic physical deficit and combine it with investors seeking a hedge against inflation, you get the exact market demand dynamics, keeping silver firmly anchored above the $60 resistance level. Plainly said, $60 is silver's new floor, or maybe it's $55, who knows. So whether you're watching paper index movements, tracking central bank policies, or stacking physical bullion at home in your safe, staying informed is your single greatest asset in today's economy. If you enjoyed this breakdown and want to have a little bit of news without all of the fluff, please take a quick second to hit that like button and subscribe to the channel. It costs nothing, but it makes a massive difference in helping our channel reach more viewers across YouTube. If you'd like to support our work even further, check out the Super Thanks button right below this video. Maybe join our channel membership community for pre-release on videos and other perks. Or maybe explore our links in the description box below for our trusted partners and community discount codes. Thank you for tuning in. Stay safe, keep building real wealth, and I'll see you in the very next update as you remain classy and current with the culture of currency.